Picture this. Tokyo, November 17, 1997. You are Hiroshi Tanaka, a salaryman, standing in front of an ATM that has just told you the daily withdrawal limit is 100,000 yen. Not the new account limit, the total, per day. The same machine, the same card, the same bank book that shows 47 million yen accumulated over 40 years of paychecks. 47 million divided by 100,000 is 470 days. 470 days to take out money that has been yours since 1957. The bank is solvent on paper. The bank is dead on liquidity. The line behind you keeps growing. Nobody is calling this a bank run. Officially, this is full depositor protection. This isn't dystopian fiction. This was Japan. Hokkaido Takushoku Bank, the 10th largest in the country, founded in 1900, designated a major city bank in 1950. Your wife Keiko has another account at Yamaichi Securities, Japan's 4th largest brokerage, 102 years old, customer assets legally segregated from the firm's own positions. 7 days from now, that account freezes too. And it has happened again and again. Reykjavik, 2008. The krona collapses. Icesave depositors lose access to £4 billion for 18 months. Athens, 2015. Capital controls. €60 a day per account for 3 weeks. Same architecture, same trigger, same outcome. When the bank's portfolio freezes, your deposits become a number on a screen, not money you can spend. Here's what keeps me up at night. The mechanism that did this to Hiroshi was never dismantled. The Allied occupation formally dissolved it in 1947. The same families rebuilt it under a new name by 1962. It was operating in 1997. It is operating in your country today under a different name with different letterhead. By the end of this, you will see exactly why every rule Hiroshi followed, same employer, same bank, second account at a separate institution, the diversification the Ministry of Finance pamphlets recommended, was inside a single cross-shareholding network the entire time. And you will see how to tell whether your own savings are sitting in a similar one. In 1947, the Allied occupation dissolved Japan's Zaibatsu conglomerates to prevent the industrial networks that had funded the war machine. Here is the first thing most people get wrong about that dissolution. They think it worked. 3 pieces mattered. First, the decree. Supreme Commander for the Allied Powers, Economic Section Directive. Mitsui and Mitsubishi, the largest Zaibatsu, had their signage removed from Tokyo bank branches in 1947. A photographer captured Ministry of Finance officials watching the metal letters come down. The record documents formal dissolution. Second, the reconstruction. By 1962, identical bank networks had re-emerged under Keiretsu structures. Same families, same cross-shareholding architecture, same Ministry of Finance officials, now older, appeared at ribbon-cutting ceremonies as Mitsui and Mitsubishi signage returned to the same branches. The ministry called it economic recovery. The Bank of Japan archives document administrative guidance, informal coordination between the Ministry of Finance and banker networks that rebuilt what had been formally dissolved 15 years earlier. Third, the stability illusion. From 1945 to 1997, 52 years, no major bank failure. Japanese households placed 54% of their financial assets in bank deposits. Americans placed 13%. The difference was not trust, it was structural lock-in. Lifetime employment contracts bound workers to employer-designated banks. Salary deposits, mortgage, retirement contributions. One bank, one employer, one life cycle. Hokkaido Takushoku Bank, founded in 1900 as a colonial development institution, designated a major city bank in 1950, was part of that trusted establishment by November 1997. 7 days before it collapsed, Ministry of Finance Vice Minister Eisuke Sakakibara told the press, "The stability of the Japanese banking system has been maintained for over 50 years without major depositor loss. This record speaks to the strength of our institutional framework." By the early 1960s, the same families controlled the same banks under different legal structures, and the Ministry of Finance called it economic recovery. The rebuilt system had one elegant feature. It made wealth extraction invisible until the moment liquidity vanished. When Hiroshi deposited his monthly salary at Hokkaido Takushoku, the cash moved through 3 transformations in under 90 days. First transformation, cash becomes a loan. An affiliated company walks into the bank. The company needs capital. The bank opens the vault. The bank hands over depositor cash as a corporate loan. The loan appears on the balance sheet as an asset. Hiroshi's deposit still shows in his passbook. Both claims exist simultaneously. Second transformation, loan becomes equity. The company that just borrowed depositor cash turns around. It walks to the brokerage desk in the same building. It buys shares of Hokkaido Takushoku Bank. The bank now owns the company's debt. The company now owns the bank's equity. This arrangement had a name: Keiretsu, a reciprocal equity holding structure where banks and corporations held each other captive through circular ownership. Third transformation, equity becomes illiquid. The bank held equity positions in 247 companies. Those 247 companies held bank equity reciprocally. When one company's value dropped, the bank's equity position declined. When the bank's stock fell, the company's balance sheet weakened. The circle amplified losses in both directions. Here is what that looked like in practice. October 1996. A board meeting at Hokkaido Takushoku headquarters in Sapporo. The bank director presents a chart. 5.2 trillion yen in loans to Keiretsu companies. The treasurer asks, "What percentage is recoverable if equity prices fall?" The director responds, "The question is not relevant. These companies cannot fail because we hold their equity and they hold ours." Banking Act Article 10 permitted this structure. Depositor funds and corporate lending pools, legally commingled. No segregation, no consent required. Hiroshi never authorized his salary to become collateral for a corporate equity position. The law did not require authorization. By 1996, Hokkaido Takushoku held 9.8 trillion yen in total assets. The published record shows the bank's equity portfolio was built entirely from depositor cash transformed through Keiretsu lending. When asset prices began falling in early 1997, the circular structure became a trap. Companies could not repay loans because their equity values, held by the bank, were collapsing. The bank could not call the loans because forcing company failures would destroy the bank's own equity positions. The mechanism had been rebuilt identically after 1947. Same families, same banks, different legal structure. By the time his deposit hit the quarterly balance sheet, his yen was a line item in a 5.2 trillion yen portfolio of corporate equities he never authorized and could not liquidate. Here is what that looked like for one salaryman on November 17, 1997. On November 3, Hiroshi walked into the Shibuya branch ATM lobby to withdraw 500,000 yen for quarterly tax payment. He wore the same dark suit he had worn for 40 years, company uniform expectation for a salaryman who had entered Mitsubishi Heavy Industries in 1957 at age 20. The ATM screen lit up. He inserted his bankbook. The machine dispensed 50 crisp 10,000 yen notes without hesitation. He folded them into the leather wallet his wife Keiko had given him on their 30th anniversary. That was the last normal transaction. 7 days later, November 10, he returned to pay the mortgage, 180,000 yen due by the 15th. He inserted the card. The screen displayed a new message. Daily withdrawal limit, 300,000 yen. He withdrew 300,000, enough for the mortgage and groceries for the month. November 14, he needed to withdraw another 200,000 for the quarterly utility reconciliation. The screen message had changed again. Daily withdrawal limit, 100,000 yen. He stood in front of the machine for 6 minutes. The LCD glow reflected in his glasses. 100,000 yen per day. He had 47 million in the account, 40 years of salary accumulation, minus the apartment down payment in 1978 and his daughter's university tuition. All of it sitting in Hokkaido Takushoku Bank because his employer deposited his paycheck there every month since 1957, and because Japanese households kept 54% of all savings in bank deposits, and because no major Japanese bank had failed in 52 years. November 17, morning. The Ministry of Finance announced nationalization. Hokkaido Takushoku Bank, the 10th largest bank in Japan, was insolvent. By 2:15 that afternoon, steel shutters sealed the Shibuya branch entrance. The ATM remained operational. Daily limit, 100,000 yen. Hiroshi went home. He sat at the kitchen table in the small 2LDK apartment in Shibuya Ward, where he and Keiko had lived since their daughter was born. He opened a notepad. He wrote the numbers. 47 million yen in the account. 100,000 yen per day maximum withdrawal. 470 days to access his own capital. The mortgage was 180,000 per month, paid through the same bank. He could not authorize payment from his own account. The payment system was frozen. He would need to withdraw 100,000 today, 100,000 tomorrow, pool the cash, and hand-deliver it to the bank's mortgage servicing window, if that window still existed. His wealth had not been stolen. It had been converted into equity claims on 247 companies through loan portfolios he never authorized. And the ATM would dispense exactly 100,000 yen per day until those portfolios became liquid again. 470 days. But that assumed the equities would ever become liquid. Keiko had opened the Yamaichi Securities account in February 1995 because a Ministry of Finance pamphlet recommended diversification across financial institutions. Different institution, different account type, different legal structure. The record shows it made no difference. Yamaichi Securities was Japan's 4th largest brokerage, 102 years old, customer accounts legally segregated from proprietary trading. Keiko's 8.2 million yen sat in mixed equities and bond funds, not bank deposits, not cross-shareholding guarantees, not corporate loan portfolios. November 24, 1997. 7 days after Hiroshi's bank collapsed, Yamaichi Securities President Shohei Nozawa walked into a press conference. "We have concluded that we can no longer continue as a going concern. I am sorry for the trouble we have caused our customers and the financial system. Voluntary liquidation, 2.6 trillion yen in off-balance sheet liabilities. Corporate equity guarantees that tied Yamaichi to the same cross-shareholding network that killed Hokkaido Takushoku Bank." The Securities and Exchange Surveillance Commission report, published the following year, documented customer asset segregation was legally required but never enforced. Yamaichi had commingled customer funds with proprietary trading positions. Keiko's 8.2 million yen was already committed to equity claims on companies she had never heard of through guarantees she never signed. Her account froze. Not stolen, frozen, pending bankruptcy asset distribution. 4 years later, in 2001, the distribution completed. 34 cents per yen. On November 24, 7 days after Hiroshi's bank collapsed, her account froze. Not because Yamaichi had stolen the money, but because her yen was already committed to the same cross-shareholding network through different legal entities. 2 institutions, 2 account types, identical mechanism. While Hiroshi calculated 470 days of ATM withdrawals, Yoshihiro Nakamura received a fax at his Marunouchi office. Yoshihiro Nakamura, born 1942, Keio University, MBA from Wharton, 1968. By 1997, CEO of a mid-tier Keiretsu manufacturing company headquartered in Tokyo's Marunouchi district. Bespoke suits, corner office, 40 employees in accounting alone. His company owed Hokkaido Takushoku Bank 340 million yen. Standard Keiretsu arrangement, preferential lending rates, reciprocal equity holdings, board representation on both sides. The bank held shares in his company. His company held shares in the bank. Cross-shareholding, mutual protection against hostile takeovers and external pressure. November 17, 1997. The fax arrives at 9:42 a.m. Ministry of Finance restructuring terms. 1 page, 3 paragraphs. His company's 340 million yen loan obligation converts to preferred equity in the nationalized bank. Conversion rate, 2 yen per 100 yen of debt. He puts down the fax. He picks up his calculator. 340 million times 0.02, 6.8 million yen. New obligation, 6.8 million. Old obligation, 340 million. Difference, 333.2 million yen. Erased. No bankruptcy filing required. No workforce reduction mandated. No production halt. The company continues operations. The ministry restructuring protects Keiretsu member firms. Corporate registry records from 1998 show his company survived without restructuring. Contrast. Hiroshi receives 1 yen per yen of his deposit. Eventually, after 470 days of frozen access, full nominal reimbursement, but only after the liquidity freeze ends. Nakamura receives 98% debt forgiveness. Immediately, November 17, the day the bank collapses. The Ministry of Finance restructuring converted his company's 340 million yen in bank debt into preferred equity at 2 yen per 100, a 98% write-down that cost his company nothing and required no bankruptcy filing. Let that sink in. The Ministry of Finance imposed the withdrawal limits under Banking Act Article 71, a provision written in 1927 and never amended. Here is how the mechanism worked in practice. November 17. Ministry of Finance announces nationalization terms for Hokkaido Takushoku Bank. 2 separate protocols, one for depositors, one for corporate borrowers. Depositor Protocol. Principal honored at 1 yen per 1 yen. Banking Act Article 71 allows the Minister of Finance to impose withdrawal restrictions during nationalization. No diet approval required. The Minister issues administrative guidance. The banks comply. ATMs go dark. Branch queues form. Daily withdrawal limit drops to 100,000 yen. A depositor with 47 million yen in savings needs 470 days to access his own capital. The inflation rate in 1997 was 0.5%. 470 days of frozen savings, effective purchasing power loss of 235,000 yen. The ministry called this full depositor protection. Corporate Borrower Protocol. Keiretsu loan restructuring through Ministry of Finance administrative guidance. No diet approval required. Corporate debts converted to equity at 2 to 5% of face value across the Hokkaido Takushoku portfolio. Studies indicate approximately 5.2 trillion yen in Keiretsu loans recovered at 2%, 104 billion yen actual collection. The ministry called this market conditions for non-performing assets. Yoshimasa Nishimura, Ministry of Finance, Banking Bureau Director General. December 1997, Diet Testimony. The withdrawal restrictions are temporary measures to ensure orderly resolution. Depositor principal is fully protected. corporate restructuring terms reflect market conditions for non-performing assets. Depositors received every yen they were owed. Corporate borrowers paid 2 yen per 100. The law treated both as full resolution because it measured nominal value, not liquidity or time. In April 1998, 4 months after Hokkaido Takushoku collapsed, Japan passed deposit insurance legislation guaranteeing 10 million yen per account. Now here is something uncomfortable. Japan reduced cross-shareholding from 18% of Tokyo Stock Exchange market capitalization in 1996 to 8% by 2020. The 3 largest banks, MUFG, SMBC, Mizuho, all retained Keiretsu equity holdings in their portfolios. The published annual reports document the positions. The structure is smaller. The structure is not gone. Take that arithmetic to other developed economies. October 2008. The United States FDIC issued an unlimited deposit guarantee for systemically important financial institutions. The emergency measure ran until 2010. The precedent remained. Insurance has a number. Systemic importance has a name, but no number. July 26, 2012. European Central Bank President Mario Draghi delivered a speech in London. Whatever it takes to preserve the euro. Not a law, not a formal deposit insurance expansion, an implicit guarantee that sovereign bonds, which European banks held in quantity, would not default. Government backing for deposits by proxy. Iceland, 2008. Icesave depositors, £4 billion held in cross-border accounts. UK Treasury records document the loss. The deposit insurance framework existed. The cross-border application failed. Depositors could not access their capital for 18 months. 3 jurisdictions, same entry ticket. A government guarantee on nominal value. No guarantee on liquidity if the underlying portfolio becomes unmarketable. Bank of Japan Governor Masaki Shirakawa gave a speech in April 2009 on the lessons from 1997. One sentence from the published record: deposit insurance alone cannot prevent liquidity crises if the underlying asset portfolios are illiquid. The structure of bank balance sheets matters as much as the guarantee. The insurance protected nominal value. It did not address the mechanism that had converted Hiroshi's deposits into corporate equity in the first place, and that mechanism remains operational in modified form across Japanese banking, European sovereign debt markets, and US systemically important financial institutions. Which brings us back to Hiroshi's kitchen table in November 1997. Hiroshi's kitchen table notepad showed 470 days of calculations. But here is the kicker. Hiroshi did everything right. He worked 40 years at the same company. He deposited every paycheck into the bank his employer designated. He saved 55.2 million yen across 2 institutional accounts, Hokkaido Takushoku Bank and Yamaichi Securities. He never speculated. He never took risk. He followed every institutional rule the system gave him. And he lost 5.6 million yen in effective value. 470 days to withdraw his own money from Hokkaido Takushoku. 26 months from November 1997 to January 2000. Keiko's Yamaichi account paid out August 2001. 34 yen recovered for every 100 yen deposited. A 66% haircut on 8.2 million yen of savings they had accumulated through the same institutional obedience. The institutional permanence he had trusted for 40 years was not a guarantee of stability. It was the mechanism that made his wealth extractable the moment the equity portfolio collapsed, and every salaryman who followed the same employment contract rules faced identical math. So far, we have seen how deposits became equity, how liquidity froze, and why corporate borrowers walked away whole. But there is one more layer. So far, we have seen how lifetime employment created single institution dependency, how cross-shareholding converted cash into equity, and why Hiroshi's 47 million yen became inaccessible in 14 days. But there is one more layer. Here is the protocol, the record documents. First, employer-directed deposits. Salaries routed by company into a single designated bank. Standard practice under lifetime employment. 40 years of accumulated capital in one institution. Hiroshi had no choice where his paycheck went. Second, equity-backed lending. Banks lent deposits to Keiretsu companies. Loans were secured by shares held in portfolio. Cross-shareholding structure. Cash deposits became equity exposure without depositor consent. The bank held stock, the borrower held cash, the depositor held a claim on both. Third, nationalization with liquidity freeze. Ministry of Finance intervention, November 1997. Deposits protected on paper. Withdrawal limits imposed for weeks. Corporate loans restructured. Shares worth a fraction of their loan value. Recovery rates in single digits. Employers walked away. Depositors waited in line at ATMs with 100,000 yen daily limits. 3 mechanisms. 1 outcome. Deposits became equity. Equity became worthless. Liquidity disappeared. Corporate borrowers restructured, depositors queued. The record shows this sequence at Hokkaido Takushoku. The record shows the same sequence at Yamaichi Securities. Same month, same mechanism. Widespread exposure across millions of households. 3 mechanisms. 1 outcome. Repeat across 54% of Japanese household financial assets. Which brings us to the question you should ask your own bank. Full timeline with sources at the link below. Ministry of Finance documents. Bank of Japan emergency liquidity reports. The forensic record from November 1997. The real question is not whether your deposits are safe. The real question is whether you know what your bank owns. Cross-shareholdings, corporate equities, sovereign bonds that become unmarketable when portfolios turn illiquid. Drop a $100,000 withdrawal slip in the comments if you have ever checked what % of your household financial assets sits in a single institution. Subscribe. Every week we take apart another mechanism the textbooks won't explain.